One common misconception among investors is the belief that buying a fund just before it announces dividends is a smart investment strategy. However, this myth overlooks a crucial aspect of evaluating a fund's performance. In reality, the true measure of fund's success lies in how its net asset value moves, rather than the frequency or amount of its dividend payouts. This video aims to debunk this myth and shed light on the actual factor that determine a fund's performance. The misconception that buying a fund before it declares dividends will yield higher returns stems from the notion that dividends are a significant indicator of a fund's profitability. While it is true that dividends are paid out of a fund's accumulated profit, their announcement does not directly impact its overall performance. Instead, a fund's success is determined by the movement in its net asset value. The net asset value represents the total value of fund's asset minus its liabilities, divided by the number of outstanding shares. It serves as an indicator of the fund's underlying portfolio performance. When a fund announces dividends, it simply means that a portion of its accumulated profit is being distributed to the shareholder. However, this distribution does not necessarily reflect the fund's current performance or future prospects. In fact, when a fund decides not to declare dividends, the unallocated profits are reinvested back into the fund's portfolio. This reinvestment leads to an appreciation of the net asset value. Thus, even without dividend payout, the NAV experiences growth, benefiting investor indirectly through increased share prices. By focusing solely on dividends, investor may miss the bigger picture. Dividend payment should not be the primary criterion for evaluating the success of a fund. Instead, investors should assess a fund's performance by examining its NAV movement over time. A consistently increasing NAV indicates that the fund's underlying investments are generating returns and contributing to its growth. In conclusion, the notion that buying a fund just before it announces dividends is a profitable strategy is a myth. A fund's performance should be evaluated based on the movement of its net asset value, which reflects the overall performance of its underlying investment. It is important for investors to focus on the NAV appreciation and consider the fund's long-term growth potential rather than relying on short-term dividend expectations. By understanding this distinction, investors can make more informed decisions and achieve better results in their investment endeavors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing. For more information, visit kuvera.in.